Welcome back, guys. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi, everyone.
Thank you for joining us today. And we're going to explore a topic that is maybe up your alley, depending on where you are in your life. But someone basically messaged us online, asked a very simple question. How do you start investing if you have a limited budget, like say $200 a month? So, I mean, we've been rating some portfolios recently, right? And there's like six-figure portfolios and all that. But for someone who maybe just starting out, maybe still in NS, still starting their career, maybe they can only save a few $100s a month. How do you start investing, or what is the best way to start investing? So why don't we, explore that topic and hear what you guys have to say about that?
If you are starting out, I think the best. I mean, with $200 a month, obviously, personally, I will just continue to save up until like a few $1,000s, and of course, I will then invest in stocks, okay, or even like ETFs. Okay, so. But before you do that, I think it's important to really like invest in yourself first. Okay, so sometimes investing doesn't mean it has to be financial. It could be like knowledge. So when I first starting out, I was reading tons of books. I still remember I was spending my days at library because it's free, the books, so I don't even need to spend the money to go and buy those books. And read a range of topics like forex, options, and then finally I led into value investing, and then now dividend investing, growth investing, and that actually pays off over time. Okay, so that investment alone, I mean, it requires a lot of your time and commitment to go and read up and learn more about it. Okay, so to me, those are the best investment earliest in my life. Okay, during early parts of my life, even until today, I'm still investing a lot of time reading just to upgrade myself. All right, so that is, although you don't really get to see the financial return out of it, but over long term, as you continue to save up the amount of money, let's say $200 a month, you can actually, as you know more things, what type of assets that you want to own. I mean, what I figure out is that equities is one of those assets that will give us the best return over time, right? But for someone who doesn't understand what equity investing is all about, right? You can give him or her $1 million, and then you put money into that, and he doesn't have that knowledge or temperament to go about handling that money. I can give him the best or her the best stocks, right? But that may end up as a disaster.
That's a really good point, because I think you guys remember many years ago there was someone, I think whose husband got in an accident at the airport. I think it was like a cleaner or something like that. And it was, I mean, very tragic and stuff. And the wife actually received, I think, $1 million from crowdfunding because they were just so, the husband just passed away like that.
I remember it's a Malaysian.
Was it Malaysian?
Malaysian,
But $1 million. That was
cool. At that point of time, it's about 2.5 million.
Wow, has inflation gone up so much? But anyway, $1 million. And it was gone within a year or something like that.
And she came back to the newspaper to ask for more.
So it just goes to show that this financial literacy is so important. And just knowing how to manage money. It's just so important.
And I think starting small is really helps a lot to build your foundation, because I mean, for someone can start out with again $1 million portfolio versus someone who start out with $1,000 every year that they save up. The result can be very different over time. And for someone who doesn't have financial knowledge, start off with 1 million, I can highly likely that person is going to lose money, and the amount of losses that suffered could be like in 6-figure, right? Versus someone who, like, let's say you start out with just a 4-5-figure type of portfolio, the losses that you suffer, it's a lot more minuscule, right? And the lesson that you learn out of it is more impactful, right? So that starting small, I think, is a big advantage for people who are starting from there, because you have a lot of time to really go and learn how to do it the right way once you have the capital, right? And of course, along the way, as you learn, you have more skill set. You can actually do side hustle to earn more income, and hopefully you can grow that 200 to 300, 400, 500 over time, right? And that will also help you to be more disciplined on what you spend. Because if I were to give you money straight off, you might be like, easy go, right? Easy come, easy go, right? But if it's like hard to come in, you will really be more careful on how you plan your financial. And that's where I think, for me, I think for a lot of people who start out from ground zero, that's where they actually build that framework
Mm-hmm.
along the way.
I think there's a saying that if someone has constraints and limits to work around, they become more creative.
Yeah.
They become more intelligent with decisions. But if you give them like, you know, just carte blanche, do whatever, then you just become lazy with their decisions. Because it's just like whatever, you know. So working with some amount of restraint limits actually is quite useful. So $200 a month. I mean, so like you're saying, go to the library, read books. Books are cheap. I mean, like
nowadays you have YouTube
channels like this one. It's not just us. There are other people out there you can listen to as well. Because I mean, everything that we share is based on our experience. But you will have your own experience as well. What you like, what you don't like, how you want to invest. How else can they learn how to invest?
I think the most typical route that most people will say is to invest in the index, because $200. Right? You can dollar cost average into the index, right? And let's say you do it, not say a monthly basis, but maybe a quarterly basis, so that the commission is much less, right? Over a 30 years period, for instance, let's say a 7% growth will be around 228,000 after 30 years, right? But if it's a 10% growth, is around slightly more than 390,000. I have the chart over here, right? So that is if you consistently invest the same amount in the index, this is what you're going to get, right? So I think that's a more conventional way. Like when you tell anybody, people say, okay, this is the right way. You go to subreddit Singapore FI, they say this is the way, right? But I just want to provide an alternative way to let you see other possibility that you can look at. So basically, I read before an article about what they call the coffee can portfolio. So basically, what is a coffee can portfolio is that you buy the stock and you just forget about it for the next. They say it's 10 years, but I say just forget for the next 20, 30 years. Right? So the article actually says that this guy, right, he didn't pay attention to any sales recommendation from his analyst, the analyst report, but he buy all the all the buy recommendation. So he just buy, then he just leave it and chuck it aside and forget. Then every time he go on buy recommendation, he just buy only that one stock. And he leave it for his wife. Eventually that amount, right, some stock die out, some stock grew, and some stock grew very substantially. In the end, the whole portfolio did also quite well on that. So they call it the coffee can. It's like the olden days, your grandmother put all the money inside the can, right? So that's the way they say you put and forget, right? But of course, in Singapore term, we call it the Milo tin can portfolio. I mean, if you are Singaporean, usually you don't put in coffee can, you put in Milo tin can. Right? So why I'm saying that is that, let's say you got $200 a month. Within 1 year, you will save about 2,400. So let's say you want to invest, you say until 1,000 invest, right? So every year, right, you at least got 2 chances, right, to invest in 2 companies, right? So I'm saying this method is because I've seen people did it before, and it turned out well for them. But it may not suit you, but I'm just giving you an alternative views. So basically, this style is it's like a venture cap style, right? You just invest the 1,000 to the companies, right, that you feel is like the company is like new tech, or it's like they are out to change something. And these companies are usually founder-led. And they are not those like mega big companies. They are just like maybe the small and mid-cap companies. They have they're really out there to disruptive technology to disrupt, right? You just put, let's say $1,000 in them, and you just leave it, and you see how it grows. So I can show you a few examples from here. So let's say if you bought Netflix from 2004, in 2004, you invest $1,000 in 2004, you hold until now, right? I round it down roughly, it's about 175,000 after 20 years. Right, your $1,000 becomes 175,000. Right, your Nvidia 1,000 becomes 753,000. Your Apple 1,000 becomes 437,000. Booking.com you buy 1,000 becomes 187,000. Amazon you buy 1,000 becomes 75,000. So Intuitive Surgical, which the one that do robotic, trying to disrupt the way of like doing remote surgery, right, 1,000 become 225,000. Right, so all these are done in 20 years. So easily all these can cover up if you invest in index 30 years, you can cover up all this. Have not include that you still got other stocks that you own, Right. So these are what I call the outliers. Eventually, when you buy and buy, you'll definitely there will be a few outliers. There will few will be doing okay only, and there will quite a lot that die out. But the one that doing okay and outliers, right, will carry your whole portfolio. right? And you just leave it down there only.
Yeah,
and let it go.
if you notice, Victor mentioned a lot of them are US company. Very little outlier in Singapore.
Yeah, don't do it in the Asian. Do it in the US companies.
Okay.
Yeah, I think it makes more sense.
I mean, the article that you shared, it sounded like a random, almost like a random pick. There was a recommendation from the analyst. He just said, okay, fine, I'll just put some money there.
Yeah.
And then he didn't touch it. But how old was that report?
The guy was did in the 1950s.
1950s. So someone could argue, hey, it was because of the growth of the US economy overall. If you just pick one or two stocks, three, all are going to go up.
But at that point of time, you don't know what all these are new, like Netflix and Nvidia at that point of time was new.
So how do you?
I'm telling you this because I've seen someone did it before.
Okay.
Right. In back in those. Right. They shared the story and they did it before.
Okay.
Right. The 1950s is another example because the guy just buy based on recommendation.
Yeah.
Right. So a few things I can see. You can see which is the most popular one. Right. Whether they have growth. Most importantly, I feel it must be founder-led and they must be disrupting something.
Okay, so there's some criteria that you must go through.
Yeah.
And then you kind of like just put
1,000.
1,000. It's almost like a bet for the future.
Yeah.
And then you put multiple bets across a bunch of these companies.
Yeah.
And then maybe one or two
must
just
you
explode.
buy until maybe 50 companies
50,
or what? Or you can put 500 so up to you.
And remember not to monitor them every day.
No, you're supposed to put and
just forget.
Okay, so basically the guy in the 1950s that did it, right? He got the because at the point of time he still had share certs.
Okay.
He'll just chuck it aside.
Yeah.
So forget about it.
You forgot where you put them.
Yeah, but now cannot. You must put away
your
phone.
You can just log in anytime.
You must put away your phone or you change your password.
These apps.
It's quite different. Okay, so how would someone who is like just starting out $200 a month, why would they pick something like that? Why would it make sense for them?
Okay, so I'm saying that is because since you're going to put, let's say, in index, the most sensible way is to put in the index. But you 30 years, that's your return, right? I mean, based on some.
Okay.
People say the S&P 500 is like 10%.
Yeah.
10% is because the past few years the interest rate is low. But you look as a overall of the index, right? It's about 7%, right? But if you calculate like real returns minus 3% inflation, it's about 4%, right? So if you want to get higher returns, sometimes you have to think the not so conventional ways, right? Like alternative. I'm not saying that I'm not randomly trying to give you an alternative idea, but because I've seen someone did it, and this person who did it right spread and is very consistent throughout the strategy. He didn't divert, right? Yeah, you do not divert your strategy. You stick to your strategy. You just invest small and small. And usually when you do this strategy, the percentage of each stock is very small only.
Okay. Yeah. So does someone need a lot of emotional maturity to do something like that?
I think you need to have some sort of understanding of the business or read about it to understand, right? Okay. So for the person that I know, they subscribe to like research services. Then when they recommend the stocks that are high growth, disruptive, founder-led, based on these few criteria, they just buy. Okay. Yeah.
Actually, I hear what you're saying. So if I were, this is my take on your alternative, it could make sense. So I mean, for someone who's only has $200 a month, you put that into the index. It's a slow way to grow your wealth, and if your income is so small, it's going to take a long time.
Correct.
Right. If you're a 6-figure earner, you can put a lot more money. It compounds faster. Compounds bigger. But if you're small money, I kind of see how it makes sense that instead of like putting it in an index, hey, it's a small amount of money. I'm just going to put in like a few of these bets that I really like.
Go home or go big.
Yeah, go home big. But it's a small amount because you still a small amount. Yeah. But then for me, personally, I'm not comfortable investing that way for the rest of my life because that's not the way I want to build my wealth. But if you're a small amount of money at the start, just do that, maybe 1 or 2 bets. Some people actually like go into crypto, stuff like that. And then once you've like have this coffee can portfolio, like you say, 50 stocks maybe. 50 stocks could take some time. Maybe I would stop at like 10, 20, I don't know. And then once I start to have a bit more money, I'm going to go, hey, that is my coffee can portfolio. I've placed my bets. Let's see what happens in 20 years, 30 years time. Let's see if I strike the lottery. The rest of the time, the money that I make, I'm going to invest in an index.
Dividend
stocks. I'm going to build a more sustainable predictable way of making money. And then that kind of makes sense for me. That's how I would combine the two.
I mean, you can do that, but it's just that I feel if you want to just stick to one strategy, then you just keep it to 50 to 100. If you mix coffee can and what you You must really forget.
Yeah, I really forget that.
Yeah,
But it doesn't have to be
Yeah.
a either-or strategy.
Correct,
If I invest this way, it doesn't mean I can't invest that
I think
way.
the most important thing about coffee can portfolio is, right, you need to let all these stocks run.
Yeah.
And you really need to forget about them. Okay,
Yeah.
I'll give you an example, right? So recently, Rusmi and I, we met with one of our members. He was sharing us that many years ago, he bought one of this company at IPO. Right? He just buy $1,000. And he totally forgot about this company. Right?
Okay.
So in recent years, he went back. It's this company called CSL in Australia Exchange, right?
Okay.
And his friends start talking about it. Then he was saying, what is this company? Very familiar.
Okay.
So he remember, I bought this company. So he went back and checked his account. It's close to $1 million. His $1,000 close to $1 million.
Okay.
And I checked, it's like about 20 years.
Okay.
Yeah.
Right? But I was sharing with him that I said, if you have lucky, you forget. Because if you have see the thing went up 10 times, you will sell. That's the thing about human. Your emotion will ask you to sell every time when you go up 10 times.
Okay.
Yeah.
Yes, that's true. I mean, but in this example, it was a bit of luck involved because it's just one stock. Because you in this coffee can strategies, you have like 50.
Correct.
This
So
guy just managed to just hit that one.
Correct. Yeah, but I'm just saying that
yeah.
is you sometimes when you do this coffee can, you must do and forget.
Okay.
Yeah.
Right. Come back in 20 or 30 years.
All right. And I can see the appeal for some people who like to make. I mean, Google does the same thing.
Because
right?
some people, let's say, of course, if you are perpetually set at $200 a month, that's the max amount you can save because of your family expense and your salary don't increase. Then you have to, I assume the person have to keep working, right? And you got no time to track. I think either you go index.
I wouldn't do it. I can't do it. I can't do it.
I mean, it's just an alternative view, right?
I can't do it. I mean, I would do it like how Alphabet does it, because Alphabet has their core business, which is in advertising and cloud, and then they have other bets. Where they put some money there, and maybe that could explode, like Waymo or longevity.
So so that comes from the earnings power of the person, right? So if you are saving up $200, this is a good start, right? But don't stop there. Continue to increase your earning power, and then of course you can scale it up with your investment.
So actually, when you do coffee can, you do 50 or 100 stocks in the end, and you are actually building your own index already.
In a way,
In a way, you're building your own index.
you are, and I mean, it's like you said, like a VC kind of investing. I'm not comfortable with it, but but I think that's
just
some
an alternative
people.
view.
Some people could definitely
because
do that.
usually if you hear people just, I will give you the conventional answer.
And some people,
but that's a good point. Yeah,
and I believe
alternative.
some of the viewers they do want to have a alternative idea. So I mean, I've seen this happen to some people in real life. That's why I feel it's good to share so that maybe some of your character can fit into this kind of style, then you can consider.
Okay.
If you are young, I think you still can do it. But if you are in your 60s, 70s, maybe
bit tricky.
a bit tricky.
And of course, if you are very risk adverse, I'd rather you go index.
All right. So the mainstream way, like, I mean, because you invest in yourself, and you learn. But the mainstream way, if it's on, let's say, okay, $200 a month, what is the mainstream way? Is this just pure ETFs? You started off that way, like a broad-based one, S&P 500 or VWRA or something like that?
Yeah. Again, it's very, very different. You see, all of us have a different way of investing. So that's why it's important for you to go and learn it yourself, and then you figure out your own rate. But if you ask me, I think the standard way is like ETFs, right? And then after that, slowly as I build up more money, I will want to put it in the growth and a mixture of growth and dividend.
Okay.
Right, because one gives me passive income, the other one gives me more capital appreciation along the way. Right, and index itself usually capture broad-based. So let's say S&P 500 is like 500 companies, right? So those companies that are very solid, they grow in terms of market cap. Eventually, they go into this S&P 500, and as they scale up 10 times, it will be still captured under this S&P 500. It's almost like it's inside. It's just that it's very diversified. Yeah.
Okay. So we have, we have talked about the ETFs available for S&P 500, the Irish domicile ones, so you can avoid the US estate taxes and the 30%.
If you're a foreigner.
If you're a foreigner, if you're not a US resident. So do check out the video as well if you want to, find out some of the ETF options out there for S&P 500. So I think for someone who's starting out, my choice would be to just pick something diversified. And just stick at it, and then focus on growing your income, so that you can grow, save more, and then you invest more as well.
Some people may also want realize that property in
Singapore
property.
is good. Property in Singapore. So there are other ways. But that was a really interesting way of looking at things, because I think a lot of people may not. I mean, it's quite uncommon. Like, do you think it's uncommon for that way of investment, the coffee can thing?
I think it's people just have to always look at their stock.
Okay.
It's getting harder now.
Yeah,
okay.
especially with the technology, right? You will want to keep looking at your stock.
All right.
Especially you can just go and search Apple share price. You know idea.
All right.
Yeah.
Right. And or if your stock just really went up 100 times and it came out in the news, let's say you own Nvidia and it just came out in the news, you will definitely go back and look, hey, did I own any Nvidia stock?
Yeah.
And when you go, hey, should I sell? Right. So I feel this method is I think it's visible, but probably only a low percentage of people can do it.
Okay.
Yeah.
Right?
Okay.
Because when you do this, you're fighting your emotion. Right. And were you there to buy and forget? Right.
That is true.
That's why so far I only see about maybe 1 or 2%
Okay.
Yeah.
that did it.
It's not easy to implement.
Real people did it, and of course based on the article somebody did it also.
Yeah.
Right. But it's not easy. Right. You still have to mold your emotion to learn about this method.
Yeah. But I think I would combine it that way, where you have other bets and then you still can have your main core portfolio. That's the way I would do it.
Yeah.
But to answer the question, how would you start investing with a limited budget, $200 a month? I think the mainstream answer will be to save up the money first. Don't do it every month because your commissions are gonna eat your your fees and everything. Save it up, and if you have a DCA strategy into a broad-based index, you can start doing that. S&P 500, the Irish domicile options, or you could go with an all-world ETF like a VWRA, and then you save up maybe every quarter, then you start investing in DCA. The other way is to, like you said, also learn how to invest. Then you can start stock picking as well. At the same time, grow your income so that you can start saving more, earning more. And I think that makes a huge difference to your investments actually, because trying to earn, you double up $10,000. Doubling up is so hard. But if you have like $100,000, just 10%.
Yes.
You make the same.
It's the same. I think investing
is a numbers game.
It's a number game.
You
need capital to grow the capital, right?
So I think a lot of times, sometimes, I think I read on subreddits as well, hey, how should I start investing and all that? And then some of them are saying, hey, look, you should focus on your career first. And think about how you can boost your income from like where you are now to like 5 figures. And then when you start investing, then it's going to be a difference. But of course, you can start investing first still and build it up along the way. But you can, I mean, it's not either or. You can always do all these things at the same time. So this is how I think we would answer the question about how you can start investing with $200 a month. I think it's pretty much how you can start with, and then how you can grow along the way.
So I think this is basically our view on how to, our different perspective. I think we may miss out at any other perspective. So if you have other ways to invest $200 a month, do comment below to let us know, because I'm also curious how will you do that. But this is how we think it. But I think you guys may have other methods also.
Some people think that bitcoins, not Bitcoin, just all the coins, crypto, coin position, 20 of them, one of them,
which is like you said, like a coffee can kind of thing. Like you just place your bets, and then one of the coins is
but the thing about the coin, these are businesses.
I know it's different underlying
assets. It's a very different. That one is like a property. You wait for the next person to price it higher.
I would say more like gold.
More like gold. Sorry,
property is a real value.
You have the assets backed by it.
Okay, so I mean, these are different ways. Like Victor was saying, if you have any other ways, that suggestions or opinions, how you could invest $200 a month and help this person who asked the question, feel free to put them in the comment section. Of course, or you can also share your own experience about how you started out when you were younger and you only had like $200, $300 a month. How did you invest and how that turned out for you? I think that would be very helpful for anyone who's watching this as well. All right, so I think that's pretty much it. Okay, so my name is Adam Risman. Victor, thank you for joining us today. Of course, put them in the comment section. Anything you need to share, please like this video. It will really help with the algorithm. And of course, subscribe to our channel. Many more long tables coming up, and we'll see you again.